Today's session will examine housing's numerous challenges for Canada's macroeconomic environment this year and the resulting risks and opportunities. Housing is unique in multiple ways for Canada's macroeconomy generally and fiscal and monetary policy specifically. It is both an essential service in providing shelter and the most valuable financial asset for the large majority of Canadians. Housing is crucial to economic growth and recovering from recessions and from slowdowns, but can create financial stability risks when booms occur or households assume unsustainable mortgage and other home-related debt. Our speaker today, Robert Kavcic, will begin with a presentation and prepared remarks. We will then move to the Q&A component with Rob that I will moderate. I'm pleased now to briefly introduce Rob Kavcic, who is back for a third year to discuss the housing market. As senior economist and director with the Bank of Montreal, Rob's balanced analysis of demand and supply has offered leading insights and a unique perspective on housing for many years now. In May 2022, he accurately forecast an extensive correction in housing given excess demand and undue buyer expectations. In GRI's housing webinar in early 2023, Rob set out why prices and sales would falter and why government supply targets were unlikely to be met. Both occurred that year. In last January's GRI event, Rob explained why supply targets would again not be met and why interest rate cuts would put a floor under house prices by the fall. Both happened last year. With thanks again for joining us, Rob, please begin.
Great. Thanks a lot, Jason, for the introduction, and again to the Global Risk Institute for having me back for another year. So that was a good snapshot of the recent history we've seen in housing, and I would say that the outlook now going forward is a little bit less dramatic, and we're kind of the view now that we've gone through the period of excess froth, we've gone through the correction, we've seen monetary policy ease, and we've seen prices more or less find a floor. Now we're going through this long period of choose your adjective, consolidation, stagnation, stabilization, where the market kind of just adjusts to a lot of the past shocks that we've seen and kind of doesn't do a whole lot for a while. And we'll look at some of the past cycles as we go through this presentation. And one of the takeaways here is that we found some stability in housing, but we're not of the view that we're going to see a really quick snapback. And it's going to be a long way back to the really frothy highs that we saw in early 2022. So I'll give you a little bit of macroeconomic context, and a quick look at the growth, the job market, and the inflation outlook, what that means for rates. Then we'll zoom in on a few issues for the housing market specifically and some of the takeaways there before we get back to some questions. So for the macro environment, I mean, we're actually in a pretty good spot here from an economic perspective. Canadian growth is pegged at about 2% for this year, which is a pretty good improvement from what we've seen over the last 2 years. Already, just in the last 3 to 6 months, we've seen some pretty good indications that momentum is coming back into the Canadian economy. Pretty aggressive Bank of Canada easing is starting to work in some interest-sensitive areas like auto sales, even real estate. So that's, from that perspective, the cycle is kind of playing out on cue, and we do look for better growth through 2025. Of course, the kicker in all of this is that we could very much wake up on January 21st and have widespread 25% tariffs imposed on the Canadian economy. And if that's the case, the calculus on all of this unfortunately changes overnight. And we've done some of the simulations on that. I know this isn't the venue to talk about trade wars and things like that, but we've effectively said, okay, if we're going to wake up with a 25% tariff later in January, then we're probably going to be cutting a full percentage point off of that growth forecast, and we're probably going to be skirting with a few negative quarters in 2025. So set that aside for now as a legitimate risk, and I actually do think we're going to see some tariff action. It's almost inevitable. But in this base kind of economic outlook, setting any kind of trade war aside, I'm actually, as a bit of a contrarian, quite optimistic on the Canadian economy this year, and we do think we're in the stage of the cycle where growth starts to accelerate a bit. So from a real estate perspective, I would say that's good news. When you look at the job market, a couple things to note here very quickly. One is that we have seen the unemployment rate rise pretty significantly off the lows. So when you're thinking about residential real estate especially, or the sector more broadly, we can always talk about things like incremental changes in interest rates or valuations and changes to mortgage rules. But at the end of the day, if you lose the job market, that's when you really lose the residential real estate market. And so this is a bit of a unique situation because ordinarily you would look at a 1.5 percentage point increase in the unemployment rate and say that's very recession like, right? The difference this time, though, is that Canada is actually still creating jobs. We've seen job momentum actually firm up in the latter stages of 2024, which is good news. But even as we're creating jobs, it hasn't been enough to match just the influx of labor supply that we've seen as a result of a very robust immigration program. So unlike past cycles, that increase in the unemployment rate isn't necessarily a big negative for housing because it's not driven by job loss. It's just driven by too much supply that we can't absorb. And then I'll get to the immigration story later on in the presentation, but when we push this forward, we actually suspect we're close to the point where the unemployment rate starts to peak and drifts down a little bit. So again, that's pretty stable and that's pretty good news. And then on the inflation front, I mean, this is a big story here that I'm not going to spend too much time on. The short story here is that as we've kind of moved through the COVID shock and through the tightening cycle, the Bank of Canada has successfully brought inflation back down to around 2%. Some of the core measures, yes, are still bouncing around that 2.5%, 3% mark, which is probably suggesting the Bank of Canada is getting near where they need to be on interest rates. But the big takeaway, the big short story here on inflation is we are effectively back to where we need to be. And so when the Bank of Canada is doing its own calculus, it's on the one hand assessing the risk that inflation is sticky or inflation is going to flare up again versus the risk of the economy underperforming what they want to see or potentially fading into a more recession-like scenario. Well, the Bank of Canada has now very much shifted towards the point of the cycle where they want to defend growth rather than protect against inflation. And so when you look at the interest rate forecast, of course, the big takeaway here is that we've already seen the vast majority of this easing cycle play out. We've seen early easing from the Bank of Canada. We've seen relatively aggressive easing from the Bank of Canada versus most other global central banks, and especially the Federal Reserve. And when we look out through 2025, again, in that kind of baseline economic scenario, we do see 3 rate cuts coming this year. So March, June, and September, 25 basis point rate cuts from the bank. If there is a risk to that, it's two-sided. One is that I'm kind of becoming of the view that the Federal Reserve is pretty close to being done easing, and the Bank of Canada, as a result of that, being back into the range of what they consider neutral, at least, is probably at risk of maybe cutting rates 1 or 2 more times, and that's it. The flip side of that, again, if we do get that trade war really break out over the next month or two, we could very easily see the Bank of Canada cut interest rates another 100 basis points beyond what we have on the forecast here, if there's a big economic fallout from those tariffs. So just some of the risks to keep in mind, but for the most part, a few more rate cuts gradually spread out through 2025 is what we have underlying this forecast. Longer term perspective, I think the story I've probably told in each of the last 2 years as we've done this session was that we're focused a lot on the ups and downs of this interest rate cycle, but from a longer term perspective, the neutral rate for interest rates is still meaningfully higher than we've seen over the last 10 or 15 years. And that's reflected on the right side of this chart in longer term bond yields. We suspect that neutral for the Bank of Canada is about 3%, and it's probably a good 200 basis points higher than what we saw between 2010 and 2019. And so to bring that back to the real world and back into the mortgage market, that would kind of imply that about 4% mortgage rates would be neutral in this environment going forward. So think about where we are today. If we have 5-year fixed mortgage rates already down in that, let's say, low 4% range, and the Bank of Canada is going to, let's say, cut rates 50 or 75 basis points from here this year, that's going to pull variable rates back down to around 4%. The market, of course, has already discounted those rate cuts. Well, what you see on the ground today with mortgage rates is probably about what you're going to get going forward, that being about 4% as being neutral. And 4% is a pretty magic number as we go through this presentation, because I think once you see, or if you were to see for some reason rates move below 4%, some of the calculus for real estate starts to become more compelling. But in that 4.5% neutral range, it's still a bit of a headwind for the market overall. And I'll show you what I mean as we go through this. So for the housing outlook overall, I think our view here is pretty subdued. So we've seen sales snap back a little bit already, or quite a bit already, as rates have come down. We see sales more or less stabilizing over the course of the year. House prices have, again, stabilized across most markets. Some markets are showing some upward momentum. And we do suspect that as we go through the middle of this year, in that baseline economic outlook, that house prices are going to push higher a little bit. And then as we get through 2025 into 2026, that kind of rebound curve starts to flatten out. And we see roughly about 3% annualized house price growth at the national level going forward. And again, it takes us a long time still to get back to those 2022 highs. And then on the supply side, I think we're of the view that, of course, the industry has been building all out. Some of the conditions out there in the market are becoming a little bit more challenging on the supply side. We're seeing a lot of purpose-built activity, yes, but because investors have more or less vanished from the market, and investors are a big source of funding to bring new condo projects to the construction phase, for example. Over the course of 2025, 2026, we suspect housing starts are actually going to continue to ratchet down a little bit. So again, that's very contrary to what federal policymakers have been pushing for. And I mean, so far, as Jason mentioned at the start, we've seen just the reality on the ground that we can never double or triple the rate of construction in Canada, especially when home builders are already operating all out. So that's the overall view. When you look down at the regional level, I think some things have become pretty clear here. So this is just a snapshot of the residential market balance across different cities in Canada. So it's the sales to new listings ratio, supply versus demand flow effectively. So higher on the screen would be a tighter market. It would be a market where demand is coming in hot relative to supply, and prices are seeing some upward pressure. So again, pretty consistent story to what we've seen over the last year, where markets like Calgary, most of the prairies, even parts of Quebec and Atlantic Canada have been very well bid because, for one, the supply hasn't been as robust, but also we see a lot of demographic flows into those areas, and the valuations never got out of whack. Where most of the correction was in the markets like Vancouver and Southern Ontario, but even in those areas, think about areas like the Barries, the Hamiltons, Londons, even some of the cottage country markets like the Kawarthas and Okanagan out in BC. Those markets aren't strong at all by any means, but they've come out of outright buyer's market territory and have seen conditions help put a floor under those markets. So again, we go through this year, I think for a lot of these markets, we see very modest price growth, if not pretty balanced conditions playing out. So step back and we'll kind of go back to this theme of this being a long way home and maybe the market going through a multi-year period where it just kind of gets quiet and stagnates for a while. First thing I'll highlight here is that if you look at past housing corrections, bottoms, recoveries back to peak levels, it takes time in some cases to go through the whole process. And so I would sit here and say that our baseline economic forecast would probably see house prices getting back to 2022 levels sometime around 2019. And you might hear that, or sorry, 2029. And you would hear that and say, well, that's a really long time. But in a historical context, 7 years peak to trough back to peak is not really all that out of whack. And so we've seen cases like Calgary in 2015 or Vancouver in 1995, Ontario in the 1990s being the ultimately extreme example where a lot of things went wrong. We've seen these cycles take anywhere from 6 to 8 to 10 years to fully play out. And there are a lot of kind of parallels between now and that 1990 cycle where you had pretty egregious valuations, very similar valuations going into the tops of those markets. You had a pretty aggressive tightening cycle break those markets. You had a lot of speculative activity come out. And even during the 1990s, you had immigration flows that went to very robust to actually being cut in half through the 1990s. So a lot of that does echo today. a lot of things went wrong in the 1990s that we don't expect to happen today, like a fiscal crisis and a currency crisis and a real spike in real interest rates through the middle of that decade that we don't see today. But the point here is that when you start from a point where valuations are very stretched and then underlying demographic fundamentals start to change, you can very well go through a multi-year period of the market consolidating and ending up 6, 7, 8 years down the road, right where you started from. And I think that's the process we're actually seeing play out right now. So, uh, two ways to look at housing valuations, and again, kind of argue that we're just not really ripe for a big rebound yet. First one is look at this from the perspective of a home buyer. So just think of a ordinary young family out there on the market trying to buy a house. So this is just a picture of your mortgage payment on your average priced house as a share of household income. So higher on the scale, obviously, it's more expensive and more difficult to carry. Again, just a flashback to the late 1980s, valuations today at the top of this market were almost perfectly aligned with valuations at the top of that early 1990s market. So what we do here then is say, okay, well, this is still a pretty restrictive environment for households to come in and buy housing. One of three things can happen, just arithmetically here in this valuation model. House prices can fall, which they already have, and we've again seen evidence that we've started to stabilize on the house price front. So unless there's a legitimate recession or there's something that triggers a macroeconomic event that causes forced selling, for the most part, we're going to go ahead and assume that house prices are stable, if not very gradually rising. The other thing that can happen is interest rates can fall further, of course. They're going to fall a little bit further, so that's going to help. But again, for the most part, we're more or less back to around that 4% neutral level for mortgage rates. And then the third thing that can happen is incomes can grow. And so incomes right now, fortunately, are still pretty robust. And importantly, they're growing faster than inflation again. So now that we're getting pretty solid real income growth, gradually over time, affordability is going to start to improve. But it takes time, and it takes not 3 months or 6 months or a couple quarters, but it probably takes a couple years of sturdy income growth faster than the rate of house price growth to bring affordability back in line. Now, one I mentioned earlier, sub 4% mortgage rates being kind of a magic level, because if you were to take this valuation model and then throw in, let's say, 3.5% mortgage rates, well, very quickly you get back to something that looks more in line with that pre-pandemic norm. Doesn't make valuations or affordability all of a sudden attractive or overly attainable, but it makes them a lot less restrictive. So again, the one thing I'm going to have my eye on here is if there's something that triggers or allows mortgage rates to fall meaningfully below 4%, I think I would change my view on housing and expect to see more of some more price momentum and some more activity come into the market. So that's one perspective from the homeowner side. Another perspective would be from the investor side. So I mentioned investors are more or less absent from the market right now, just because it does not make any sense at current cap rates and borrowing costs, and the fact that there are very little expectations of house price growth anymore. So that's just a quick picture of cap rates versus risk-free government bond yields. And we're going to just use a typical Toronto apartment or multifamily as an example here in this case, just to show you the history. But history would suggest that you typically get compensated for taking on the risk of owning a residential investment property. Makes sense, right? Because you have the risk of non-payment from a tenant. You have pretty tough landlord-tenant relations right now. You have very little liquidity in real estate, things like that. So you've been compensated with a premium. Well, unfortunately, right now the mechanics are such that because cap rates compressed so much as the market was really strong, and we saw such a sudden increase in long-term interest rates, that relationship is still kind of restoring itself. So if we're of the view that neutral interest rates are more or less around where they are today, and we could see a little bit of a move down in long-term bond yields, cap rates still need to widen out a little bit, and we're not quite there yet. So hence why the investment side of the market is really dried up. We can see prices fall further, we can see rents rise. But to this point, we're not quite there. And look at it from a cash flow perspective. So this would just be the cash flow on an investment property in, let's say, the Toronto area, inflation adjusted on a monthly basis. Assuming 25% down, standard 25-year amortization. You can see very clearly why investors packed up and left the market, because for a period there between 2022 and early 2024, when the Bank of Canada was raising rates, cash flow was deeply negative for a new investor. So who is going to take on negative cash flow every month with no expectation of price growth? The answer is nobody, and the investor disappeared. So the combination of rents moving higher, prices coming down, and interest rates coming down have now started to actually reset the cash flow arithmetic a little bit. And again, we're not quite in the area that's compelling enough to bring investors back into the market. But if we were to get mortgage rates move sustainably down below 4%, we get back into the area of what was historically a little bit more normal. So that's where we are on that front. Again, and the key takeaways there for valuations out there in the housing market would be that we're not where we need to be to drive a sustained rebound in house prices, especially if mortgage rates stay where they are. But if we were to get something that pushes us back down into that mid 3% range, I think there's quite a bit more traction there. We're just not there yet. Last thing I'll look at here is some of the demographic changes that are underway, because this is really the big fundamental story beyond what's happening on the economic and on the trade front, is that we're seeing a dramatic shift in population flows right now as we speak. And I think this is pretty well documented, but it's worth going over because it is extremely important on the housing file. So that's just a breakdown of population growth over time in Canada in just terms of raw numbers. So we pushed up to about 1.4 million people in 2024. And there's a breakdown of what's driving that population growth. So the green bars are permanent immigration. That's immigration as you've always thought about it and known it to be. So people coming into Canada sponsored by an employee or whatever the case may be to find permanent residency and work in Canada, typically skilled workers and things like that. That's about 400,000 people per year. It's being scaled back a little bit as we go forward, but that's your traditional immigration program. The orange bars are births. Unfortunately, Canada just doesn't have a lot of babies anymore. Full disclosure, I'm doing my part. I have 3 running around the house, so I'm well past replacement, but I get it. Affordability is tough. Females are in school longer. They're working. They're taking on higher end positions. The fertility rate has just fallen off. That's just a natural feature of the Canadian population, and hence why we do actually need that robust permanent immigration program. The blue bars are where the story really changed the last couple of years, and those are non-permanent residents. So that would be international students, temporary foreign workers. And without getting into all the nitty-gritty of what happened in that program, the reality is now that federal policymakers looked at this and said, wow, rather than supply, we've realized that we actually have a demand problem. And we just physically cannot possibly supply housing for an infrastructure and necessary services for 1.3 or 1.4 new 1.3 million people per year. So we've seen pretty hard caps put in on the non-permanent resident component of population growth. And when we project Ottawa's targets forward, we go from 3% population growth in Canada to very quickly about 0 for 2 years. And then we settle back into about 1% going forward. So that's where we are. It's a little bit early to see it in the data, but there are some signs out there that population is slowing down pretty quickly as we speak. And so this is going to be a major change for the next 2 or 3 years, and it's going to impact a couple things. One is it's going to impact rent. So think about 1.3 million people coming into the country. What do they need immediately? They need a place to stay. And as hard as we've been pushing on the supply side, we've just, as you would expect, not been able to meet that demand overnight. And of course, the relief valve for that, when you have just massive increases in the demand curve set against a relatively stable or fixed supply curve, the relief for that is prices, right? And in this case, prices have been rents. So soaring rents have been a feature of excess demand. And now with these caps coming in, we are already starting to see evidence on the ground that rents are not only slowing, but falling outright in some markets. And think of an area like Toronto, where you have record investor-owned condo supply under construction right now. That was either intended to be flipped on completion, which is not going to work right now because prices are down and buyers are gone. So the alternative there is, well, we're going to close on that if we can and put it out onto the rental market. So there is a very, very rich pipeline of rental supply coming, especially smaller one-bedroom rental supply, right at the same time as that the demand curve for rentals is falling off because of population caps. So, if there's a forecast that I would almost certainly lock in, it's that as much as we've been arguing about or concerned about rising rents in this country, when we do this presentation next year, rents across a lot of major markets will be lower than they are today. So one thing for investors to keep in mind, and it's also an area where we're going to see some affordability relief very quickly, because as we've always said, supply takes years and years to get set up and put on the market. The demand curve can be adjusted in minutes, and it was literally a stroke of the federal policymaker's pen to get the demand curve under control here. The other aspect of this is when we look at construction activity going forward. So household formation, of course, really exploded over the last 2 or 3 years. Let's call it 450,000 households per year. Well, we're going to go through an adjustment period and settle back into something around, let's say, 210, 220,000 per year. So eventually, this is going to really balance out that supply demand imbalance that we've had across the market in Canada. So I'm gonna probably wrap it up there. I think that's the macro overview and where we see the market going. I'm not going to read all this to you. If you want to screenshot that, those are just some of the key takeaways from a report we published on this. I think last Friday. You can find it at BMO Economics if you want to see some of this on paper and written out. Basically, again, the big view is that trade war aside, we're in a pretty good spot for the economic backdrop in Canada. The house price backdrop is a tough one because we're still kind of not where we need to be on valuations, and it would be very textbook to see this market kind of grind sideways for a number of years to absorb a lot of the excess that we've seen over the course of the past cycle. Demographic change is a big one. That's clearly going to have an impact on rents, and it's having an impact already. And I will leave it at that. I'm happy to take some questions.
Rob, many thanks for your excellent prepared remarks and slides. And we now move to the Q&A component of today's event. With a reminder to please direct your questions to all panelists. And to start the Q&A period, Rob, for our first question, traditionally economists and analysts have put greater weight on employment trends and unemployment rates versus interest rates in assessing future housing demand and prices. You covered part of this very well in your formal remarks, but the first question is it still the case that employment trends and unemployment rates dominate interest rates given the size of pent-up demand for housing in Canada, current mortgage costs for renewals and first-time buyers, and the rate sensitivity of existing and potential homeowners?
I think it does. So it's almost like you think about the unemployment rate and conditions in the labor market. It's almost like it's something that doesn't matter until all of a sudden it does, and then it matters the most.
Yeah.
Right. Right. So we can argue about, okay, 1% employment growth versus 1.5 to 2. One's a really strong economy, one's a trend-like economy. In that environment where we're growing and creating jobs, you're probably going to see changes in interest rates and federal mortgage rules dominate the momentum of what's happening in housing. Until you flip into a recession and you start losing jobs, well, the Bank of Canada could cut rates 200 basis points. If we're losing jobs, it's not going to matter, right? House prices and activity are coming down. So that's probably where that switch flips to the labor market really mattering most. Now, of course, if the economy is just absolutely humming at 3% and we're growing employment at like 2%, that is going to have an impact. But I think it really is a concern when we flip into recession. And again, as we talked about in the presentation, the unemployment rate is up, but it's up because of supply, not because of job loss, and hence why the market hasn't really struggled a lot more than it did during that asset price correction. Let's call it. That was an interest rate driven correction.
Yes. For our next question, when you look at the wide range of government initiatives, particularly federal initiatives to boost affordability, whether it's larger size mortgage insurance available, lesser down payments required, and longer amortizations, etc. What is your view of the implications for and future risks of household debt given these initiatives?
Well, so we've never been big fans of initiatives like extending amortizations and changing down payment requirements and things like that, especially on the amortization front, because it's not a policy that has a long lasting benefit. In fact, it probably has a longer lasting cost, right? So think about what happens if you wake up tomorrow morning and all of a sudden have access to a 30-year amortization. Well, most households are evaluating real estate purchases based on the monthly carrying cost, right? So it's effectively like a one-time improvement in monthly carrying costs. And a household that is out there shopping, and let's say I have a budget of, I don't know, pick a number for argument's sake, $3,000 a month. Well, great. I can wake up tomorrow with this amortization and now have a $2,500 a month monthly payment. Well, what am I gonna do? I can go buy a more expensive house now because 3,000 is my budget. So what ends up happening is you change amortization rules like that, and the price of the asset just gets bid up. And after that first wave of buyers is gone, well, you're right back to where you started from an affordability perspective, but you're left with higher house prices, and you're left with those households now having a bigger debt burden for a longer period of time. So I don't think it really does a whole lot, um, to be honest, from a policy or even an affordability perspective, unless you're the first person through the door, so to speak.
Well said. So for our next question from the audience, what's happening with construction costs and how do you see that impacting housing supply?
So we had obviously a really significant run up in construction costs through the pandemic. So not just physical construction costs, things like lumber and stuff like that. Some of that has eased, and look, we've seen market conditions normalize, and we've seen supply chains open up. So construction costs of the physical inputs have more or less normalized. At least the rate of growth has normalized. The labor side is still pretty tough because, it's funny when you look at the employment numbers in Canada, we're pretty clearly seeing supply run in excess of employment in the aggregate, but there are pockets inside the economy at the industry level where we're still seeing shortages, right? And in a really roundabout way, it's like you have immigration levels of 1.3 million people per year. You think, great, there's a ton of skilled labor supply there. But not a lot of that are the electricians and the plumbers and the drywall guys that we need to actually build houses, right? In fact, what's happening is the demand for housing that that level of immigration creates runs far in excess of any kind of skilled labor supply that they're bringing in. So it actually makes the problem worse in the short term. And so from a construction cost perspective on the wage side, you're still seeing quite a bit of upward pressure because we just still don't have the labor supply. And then for overall construction costs, I mean, it filters into the cost of creating new housing supply. And right now we're kind of in this weird spot where building costs are still elevated. It's going to cost you X dollars per square foot to bring a project to completion. But because of interest rates and the lack of investors, the demand isn't there at that price level. So what happens? Nothing gets built. And in the privately owned segment of the market right now, housing starts have really fallen off. It's kind of masked by the fact that we have a lot of government support for purpose-built rental, but the private sector is the privately owned segment has really fallen off because of that imbalance.
Next question from the audience. With rents anticipated to come down in the next 12 months, do you expect changes in the dynamic with multi-family homes? And do you see their behavior in terms of more movement or continuing to live at home to saving so that they can eventually buy a house?
Yeah, so that's a good question. If I can pick up on the details of it. So one of the things that could very well happen is you see some unbundling, right, so to speak,
Mhm.
where you have a lot of households that were just didn't have access to adequate housing supply, so they kind of bundled in. You saw, a couple households in the same house, or just think of like, younger students or whatever going two per room or whatever the anecdotes would be, right? So In that sense, there is probably even more pent-up demand out there on the sidelines, because as population growth falls off and supply comes to completion, well, if you get some of that unbundling, it makes the imbalance worse, because people actually then at a better rent level move out and find a housing supply that's adequate for them. So that should cushion the blow a little bit. I don't know if it's enough to to completely offset the dynamic of all that supply that we have coming at a time when population growth goes to zero. I think that will still outweigh, and you will still see rents fall. But yeah, it's for sure a feature of just how stressed we were for supply for the last little while.
Thank you. Could you please elaborate on how the 4% mortgage neutral rate you discussed was arrived at, and in particular, how you see this spread level and expectation of this spread changes across the cycle would work given your forecast?
Sure. So things typically would work off of what we assess Bank of Canada neutral policy rates to be, right? So we would probably argue that we have Bank of Canada neutral at around 3%. You have a yield curve on top of that. So let's say we go up another 50 basis points to the 5-year sector of the yield curve. In a normal environment, obviously the curve inverts and uninverts, as we've seen the last 6 to 12 months. And then typically the mortgage market will have a spread built on top of 5-year GOC yields. So in a neutral environment, we kind of arrive at about 4% being neutral, just given that starting point for the Bank of Canada, the yield curve plus a spread for the mortgage market. And I mean, very simply, you can just go back and look at what mortgage rates were on average, let's say in the post-financial crisis decade. They would have probably been around like 2.5%. And if we just shift the whole level of everything up by 150, 200 basis points, Bank of Canada policy averaged 1% over that period. 5-year GOC yields similarly, and if we just shift everything up by 200 basis points, that's about where we end up. And then through the cycle, I mean, the last 18 months or so were a pretty extreme cycle. We can say that because of the inflation shock. So I don't think like 6.5% mortgage rates are probably something we're going to need to see again. But typically, 150, 200 basis points on either side of that might be what you would see through a cycle. So let's look at the next 18 months as an example. If we were to end up in a trade war and we were to see the Bank of Canada not cut rates to 250 basis points, but go even further and see them cut rates to let's say 1.5%, which is kind of what we're thinking. Well, then maybe in that environment, you see mortgage rates get down to like 2.75 or 3% at the lows from a cyclical perspective. But that still is operating around a neutral environment with rates at around 4.
Thank you. Very helpful. How do you see the trends in the insurance market related to climate change impacting the housing market? And I'll add to this question, feel free to go further in terms of climate change's impact on inflation. It's been cited by various Bank of Canada deputy governors, but also its impact on real rates in terms of the housing market.
Sure. So I don't have too much to say on insurance specifically, other than there's like a legitimate risk that there are markets out there, and not so much in Canada, but if you look down at somewhere like a Florida or even the west coast of California now, and unfortunately what's happening there, you could over time end up seeing markets that are almost uninsurable, right? And there are cases where it's really difficult to just get basic insurance in a market like Florida that was typically a very hot spot for investors, things like that. So it just drives up the cost from that perspective, because you have to discount the potential of that risk. For climate change more broadly, though, I think our view is that it's incrementally inflationary and incrementally one of the factors that is arguing for this higher neutral level of interest rates that we've been talking about through the presentation and some of the questions already, because it is, at the margin inflationary, right? Carbon taxes are inflationary. Various other, climate policies are incrementally inflationary, and that does push up neutral levels for borrowing costs and for real rates. So it's not the only factor. There are demographic factors. There are factors like just reshoring of production or protectionism that has kind of pivoted us out of this environment of constant disinflationary pressure to one where we're actually seeing some inflation pressure just by reshoring production and things like that. But it's one of many factors that kind of argues for neutral rates being higher.
Picking up on the regulatory side here, looking at the impacts of OSFI's B-20 stress test for housing, what's your view of the stress test effects and its changes in recent years, and how do you see its impacts looking at 2025 and beyond?
Well, so I'm not going to predict if there are any changes coming down the pipeline per se, but the last few years, I think like we're in a pretty good spot here, all things considered, right? I know there was a lot of jumping up and down when borrowing costs were 1.5%. Why are we going into a bank and qualifying at 4.75 or 5.25? Well, it's a good thing we did, right? And the conversation would be a lot different now if we haven't had households already prove an ability to pay mortgage rates that we're seeing today. So, you know, I know the real estate industry doesn't love it, but historically, it's kind of another feather in Canada's cap of having a very responsible and well functioning mortgage market that has paid off at times of stress. Like 2008, 2009 was one example. This is another example, and we talk a lot about, or at least we get asked a lot about, the renewal risk that's coming down the pipeline in Canada
Mhm.
as mortgages roll off 1.5% rates at the lows into, fortunately, not 6 or 7% anymore, but even still in that 4.5% range. The reality is that most people that borrowed at 1.5 did qualify at 5.25 if they were at a federally regulated lender. And so there's actually even a buffer now between what we're going to renew into and what we qualified at. At the same time, you've had 4 or 5 years of income growth to help cushion that as well. So so that's one part of it. Is I think it's just another feature of our mortgage market that has actually helped us out in times of stress and helped limit some of the downside that we would have otherwise seen. And for the renewal risk overall, I mean, I've never been overly concerned about it, and that's one of the big reasons.
Thank you. Regarding real residential home price growth, are you comfortable that the dynamics are balanced now and looking ahead?
For real inflation-adjusted house price growth,
Yes.
yes, I think we're pretty close to the point where we're back to neutral. And I do have a slide in that presentation deck if it's sent around. I kind of skipped over it in the interest of time, but we look at real house prices over time in Canada, and there are a few really clear episodes where if the run rate is about, like 1 or 2% longer term, actually it's about 3% longer term, the late 1980s and 21 and 2022 were periods where real inflation adjusted house prices really got out of whack.
Yes.
And because of the correction in nominal prices that we've seen, and because of the steady run in inflation over the last couple of years, inflation adjusted house prices, if you were to just follow a benchmark all the way back to 1980, we would probably be pretty bang on that long run benchmark today for the country overall. There are still some pockets like parts of southern Ontario and maybe parts of Atlantic Canada where inflation adjusted prices are stretched relative to what we've seen longer term. But for the market overall, we're pretty close to neutral again. And that's one of the reasons why we were comfortable saying that the market's going to find a floor in 2024, because that adjustment was made.
Thank you. When you look at government initiatives in 2023 and last year to boost supply, whether it's the federal and provincial removal of HST on new apartments, increased Canada mortgage bond issuance to support multi-residential housing, and up to 80,000 now in loans for secondary suites at 2% interest, how do you view the effect of these and other recent government measures on actual supply? And from your perspective, which has been the most effective?
So look, from day one, I think it was budget 2022 came out and said we're going to triple the rate of housing construction in Canada. And we kind of said, great goal, unfortunately never going to happen. Okay, we have a demand side problem. We had a demand problem with respect to real interest rates being historically negative, and we had a demand problem with respect to non-permanent immigration levels being completely uncontrolled. Okay, we've addressed that, and all of a sudden the market has started to balance out. So we found our solution ultimately. But on the supply side, you know, the trouble is, like, builders are going to respond to market conditions, and they're going to build as much as they can when the market is strong. And when the market is turned like it has now, the builders are just they're not going to build if the demand's not there or if the conditions aren't right. So we're not going to force them into supply. They're also constrained, right? So when we needed the supply most, they were constrained on the labor side. They were constrained on the policy front, like how quickly does it take to bring permits to approval and get ground broken and things like that. And this is not new. Like, look at any real estate market in any country ever. Demand changes overnight. Supply takes years to respond. That's why you have long, drawn out real estate cycles. But like, to your question specifically, I think you mentioned the HST changes and a lot of measures that have been put in place to incent and push rental supply to the market have actually worked pretty well, because unlike the private side of construction, we're seeing very, very robust levels of purpose-built rentals now in the pipeline in Canada or reaching completion in Canada. And that's a pretty big change from like the last 10 or 20 years, where purpose-built rentals have more or less been crowded out by private condo construction. So I think those policies have actually been effective, and the pipeline there is pretty rich.
If we could pick up on that very helpful response, one specific question: what's your view on pre-construction condos, especially for consumers who signed up a couple of years ago and valuations have changed since then? And how do you see this impacting this subsector specifically, the broader market, and any implications for lenders?
So I'd be pretty bearish on that side of the market still. So what kind of gets lost in some of the national conversation we've been having is that you have big regional variation, obviously, and you do have sector variation too. And we didn't get into the nitty gritty of it, but I would say if we're pretty neutral on, let's say, house prices for Canada and for even the GTA, would be pretty bearish on small condo prices within the GTA, because we do, as we talked about, we still have that pipeline of pre-con activity coming to completion. And a lot of that, let's say like 50-60% of that, depending on the project or depending on the numbers you look at, was investor owned. So that's intended to be either flipped on completion or rented out. And in both cases, the dynamics are not great right now. So that's unfortunately one factor where we have seen supply really fall off is in that segment, because it just doesn't make a whole lot of sense from the demand side at this point.
Next question. How do you see the impacts of aging baby boomers on housing, the wealth transfer to obviously their offspring, and its impacts on the market overall?
So this is a good question. And there's a lot to unpack on this. So when we talk about the market kind of stagnating for a number of years, it's because we've reached a point in the demographic cycle where peak demand has passed. So you can talk about the baby boomers. So baby boomers at their peak would be, I think, I don't want to get into too long of a story here, but so at their peak they'd be about 62 or 63 right now. The reality is they're not downsizing. A lot of them are kind of staying put. So they're not unleashing a lot of single attached housing supply, so to speak, right? Where it gets more interesting is their kids. And the peak of the millennial right now is somewhere around 38 or 39, I believe. And so personally, I've been a long time housing bull in Canada, and especially a market like the GTA, because of that wave of baby boomer kids coming down the pipeline, right? And look, I'm at the leading edge of that, so I can ask myself, what am I doing in real estate right now? I have 3 kids. I need a big backyard, a single attached house, and there are 10, 15 years of people behind me that are going to need the same thing. Well, that is peaked right now. If you go, interestingly enough, we talked about the 1990s very quickly. If you go back to like 1991, when that market rolled over, the peak of the baby boom at that time was about 39 years old. So there's a huge demographic wave that drove housing through the 80s into the early 90s. It crested, and then we went through a 10-year period of not so good housing conditions. That's if you take the baby boom then and mirror that on to their kids, the millennials today, we are at almost exactly the same point. So I actually do think like a lot of the stress on housing demand is naturally starting to fall off now. Because we've changed immigration policy, but also because millennials have pushed through that period of their life where they are incrementally adding to housing demand. They've either found a way to find a place, or they've scattered out to other parts of the country where they can find affordability. And so we've seen that peak more or less put in. And I know that's kind of a long-winded story, but that's kind of how the demographics play out into all of this.
Very helpful, both the perspective on the longer term and also the structural factors. Well, with apologies, because we have a lot of good questions from attendees, I would like to pose for our last question. Given the impact of monetary policy on housing demand since the early 2000s, and Governor Macklin's recent remarks noting the Bank of Canada's pending mandate renewal in 2026, and his question about future monetary policy and housing affordability, should the Bank of Canada put more weight on the housing market in its future policy? And should the Bank of Canada and other central banks take greater account of asset markets generally in determining policy?
So I think you have to be mindful as a central bank of what's going on out there. And I wouldn't necessarily say it needs to be explicitly put into their mandate, right? The 2% inflation target has been effective, and it's well understood by everybody. Housing finds its way into the inflation target through the CPI, technically speaking. In some cases, it finds its way in pretty quickly. Like house prices find their way into the CPI pretty quickly. In some cases, like rents, doesn't necessarily reflect really quickly what's going on in the market. We don't have to get into the details of that, but it does find its way into the CPI. I think that as the central bank, you need to be aware of what's going on out there. So yes, you got to keep in mind what's happening with asset prices and housing prices in Canada. And a good example of this was coming off the bottom in 2021 into 2022, when the Bank of Canada was looking at some of their internal inflation indicators. They're still pretty depressed, whatever the case may be, but housing was clearly taking off, and interest rates were clearly deeply negative, and it was just blindingly obvious to us that policy needed to tighten, even if their traditional metrics weren't telling them to do so yet. And ultimately what happened coming out of that cycle, the Bank of Canada, and not to their fault, a lot of central banks were in the same place, but most central banks were about a year late tightening monetary policy. And the consequence of that was prices getting out of whack with underlying fundamentals, the correction being that much deeper, the affordability challenges being that much tougher, et cetera. So again, I don't know if it's necessarily to explicitly be in the mandate, but like pragmatic approach to monetary policy, you got to be aware of what's happening out there in financial markets, because the interest rates you set do ultimately dictate what happens with valuations and animal spirits out there in the market, and it does have real economic consequences.
Thank you. Over to Nez.
Thanks very much. So based on everything you two have discussed, it's a little hard to find a factor that doesn't impact housing in Canada. We talked about everything between regulation, Government of Canada policy, immigration, and everything in between those topics. Thank you very much, Rob and Jason, for moderating and speaking to us today. It was very insightful.